the nitty-gritty details about what it's like to get a small business loan, and then some of the kind of the questions that, as an entrepreneur, it's important to ask yourself that may not be addressed in a loan application, for example. So where this thinking for me comes from is that most lenders, whether you go to a traditional lender like a bank or a mission-driven lender like Ventures, or even a completely non-traditional lender like maybe a friends or family, any one of those entities will ask you maybe for a checklist of documentation or information that they need from you before they can decide on whether or not they're going to approve this loan. And so thinking about the concept of the checklist, instead of going through a checklist of here's all the documents we need, my checklist today is really around what questions should we be asking ourselves as entrepreneurs to help you decide whether a loan is right for you, what kind of lender is right for you, and whether a loan is the right answer to your question, to your business needs. And within that, given the fact that like some of your questions you've brought up already, given the fact that we're in unusual times or there's uncertainty, we'll be able to identify which kind of lenders might be the right partners for your business. So to start with, and this is a really important kind of base level gut check question, what is my motivation for borrowing money right now? So to kind of delve deeper, you take that question and you break it down into further questions. You can ask yourself, what stage is my business? So if you're a startup business, you're just starting out, and startup in the world of lending tends to mean businesses that are in operation for 1 year or less. In this new landscape, some lenders will also look at businesses that have been in operation for 6 months or less, particularly if you opened a business in response to the pandemic. But the idea here is a startup is considered in the lender's mind a business that doesn't have a full year of financial records to demonstrate their ability to repay the loan. So, and when you're in the startup stage, you're going to need all kinds of things to start your business. You may need a new piece of equipment. You may need supplies or initial inventory, and this is really a place where a lender will say, okay, maybe we'll take a shot at your business and lend some money, but we really need to see that you're invested as well. Many startup entrepreneurs need to demonstrate outside sources of income. So we're coming right away to that question about what happens if you don't have that. And what I would say is if you're working with a non-traditional lender, so if you're not working with a bank, but you're working with a mission-driven lender like Ventures, and I'll share some others as we go along in our presentation. If you're working with a non-traditional lender, ask yourself, what else can you show as sources of income to demonstrate your repayment ability? Some lenders will look at your unemployment income. If you can verify that you've had that income and it will stay in place for at least another 6 months, you can use unemployment income sometimes as a source of repayment ability. You can use, again, especially if you're working with a mission-driven lender, sometimes you can use sources of cash. So if you say, okay, well, I'm starting a hair salon, that's my startup business, but in the meantime, I'm cutting my friend's hair, but it's not really a formalized business yet. Some mission-driven lenders will acknowledge that cash income that you get from non-traditional sources. The other thing you want to do is look at the full picture of all the money you have coming into your bank accounts each month, and try to account for where that comes from and whether or not it's consistent. When you're asking around these motivation questions and you're asking what stage is my business in, if you're not in a startup business, then for a lender's mind, you're considered an existing businesses. And an existing business is just a business in a lender's mind that has been open for 12 months or more and has kind of the financial documentation to show that first 12 months of business revenue and business history. one of the things that lenders do they don't look forward. Say, like, if I lend you this money, your business will grow and you'll use that business growth to repay your loan. They look backwards and say, let's pretend you had this. Oh no, my internet goes wild. Just let me know. They look backwards and say, in this same situation a year ago, would this business be able to service the debt on the loan? Or based on our historic financials, would this business be able to make their loan payment every month? And they use your history to determine your future. And I want to acknowledge that that can be very frustrating as an entrepreneur, because you're saying, I'm borrowing money to expand or grow in order to get new revenue. And with that new revenue, I'll be able to pay my loan. But you're looking backwards at my historic financials to make a decision. You have more flexibility with a mission-driven lender than a bank to be approved based on projections, but it still can be a tricky thing to navigate. So still thinking about our motivation for borrowing, we've determined whether we're a startup business or an existing business, thinking through the way the lenders look at those two things. Then we need to ask ourselves, really, what is the loan for? So there's all kinds of like basic things that we need in our business. One of the things that we need is, depending on your business type, is inventory. So you just may need the materials to make your product so that they can go on the shelf and then generate revenue through those sales. And there are inventory loans. Keep in mind, with inventory loans, when you get a loan for inventory, usually your term is very short because you don't want to be paying back debt for inventory that's already been sold. You want your term of your loan to match the use of what your loan is for, and for those inventory things, you don't want to be paying on inventory that's already gone out the door. Equipment. So if you can come to a lender and you can say, look, I make all of my products by hand, every single one, but if I had a piece of equipment, I could make my product more quickly and efficiently, and that would free up my time to make sales or solve other manufacturing challenges, and that would effectively reduce your costs, increase your profit margins, and give you that flex in your cash flow to be able to repay your loan. And lenders like that sort of thing because it's a clear demonstration of how your business history can be improved in order to help you grow and service the debt on your loan. The other cool thing about equipment loans is that sometimes the equipment itself can act as the collateral for the loan. So if you're in a situation where you're saying, I don't have a lot of funds, maybe I don't have a lot of outside sources of income right now because of my job situation, a good thing to keep in mind is, can you use a piece of equipment that you purchase with a loan as the collateral in the loan to maybe make yourself a little bit less of a credit risk. The last thing that comes up a lot for entrepreneurs is something called working capital. And working capital is basically cash in your business that helps you finance day-to-day operations. This happens a lot when you're trying to expand. So for example, if you've been a home-based business for a long time and you just rented a space to do your business in, maybe you don't have all the cash in your pocket to move from your home-based situation into your new business, and you need working capital, which is basically cash that goes into your business that isn't for specific equipment or supplies, but it helps those day-to-day operations. Mission-driven lenders like Ventures and other institutions that they're called community development financial institutions. They're non-bank lenders, and they tend to have experience making those working capital loans. Sometimes a big bank loan. Big banks are more comfortable financing equipment or hard assets. So still thinking through your what's my motivation for borrowing checklist. So as you're going through this checklist, you've thought, what stage am I on in my business, and how will a lender look at me and look at my business? And then you kind of, you figured that out, and then you've identified what you're borrowing the loan for. And now it's time to kind of do some reflection and take a check-in with yourself. And sometimes I want to acknowledge, sometimes these questions are hard to, there's no necessarily right answer, but it's really taking that time to process and think through, and really being honest with yourself about your business scope, its scale, and its direction. So an important thing to ask yourself is this, this thing I'm trying to finance with my business, is it genuinely a new opportunity, or is it the latest fad? Is this going to be around, is this opportunity going to exist throughout the life of my loan, or is this just something new I want to try? And the thing, like one thing that comes to mind is if you are excited about maybe a new flavor or a new seasoning for a food product that you have, and it's popping up all over the place. You see it out in the world, of lots of other similar companies are adding that flavor to their product line. That would be a time for you to stop and say, is this really something that's going to be as part of my company long-term, or am I just responding to sort of what everyone else in the market is doing? The other thing to kind of think through is, can you think about the new opportunity financing or servicing that debt throughout the life of the loan, and making sure that you are borrowing something for the long-term value of the company and not just what's happening now. Ask yourself, are you under credit pressure? And this is especially true for existing businesses. If your current loans or lines of credit are maxed out, either personal or business, and you're using that debt already to help your business stay open, think about that before thinking that debt is the solution. And I want to acknowledge that sometimes it is. Sometimes it is. Sometimes you have invested in your business with your personal lines of credit. Or sometimes you're, especially over this last year, sometimes you've had to dip into your credit cards to keep your business afloat, and refinancing that debt with a small business loan can be a good thing. But it's an important thing to really reflect on deeply, especially since if you're adding debt, if you're not refinancing debt, but you're just adding new debt, you're going to continue to feel that pressure on your cash flow. And then ask yourself, and this is a hard question to ask, but ask yourself, am I borrowing to bail out my business? The reasoning behind getting a loan is to fuel business growth. So you borrow some money, put it into service in your business, and then you generate more revenue. But if you're borrowing to keep the doors open, it's time to consider all the reasons that your business is struggling, not just the cash flow pressures, and think, what else do I need to change in my business in order to limit this pressure so that I can grow in the future? And I will say that when banks and lenders look at your financials, they'll be asking some of these same questions as well. They ask them in a less, they maybe ask them in a more direct or financial or numbers focused way, but these are kind of the underlying issues that they're trying to get at. So you've asked yourself, we've asked yourself a lot. So what's your motivation for borrowing money? And now the second big kind of question topic that we're going to get to is the time right to make this borrowing request, to make this loan request? So ask yourself, when do you need money? When do I need this money? So if you're thinking about a business strategy, say for the end of 2022, what you don't want to do is make a loan request now and start paying on the debt before that debt is working for you. So you want it, you have to be, it's a little bit like, what's the children's book, the Goldilocks and the Three Bears, where it's too hard, too soft, and just right. And with borrowing, it's a little bit like that too. Too far down the road means you're spending money on payments before that money is working for you. I needed the money last week, and this is a true pressure for entrepreneurs. You can wait too long to make the loan request, or you can work with a lender that can't meet your needs in a timely way, and then all of a sudden say you're late on your payments to your suppliers because you didn't get the loan, or you've had to use your own money to pay for the things that you plan to do with the loan. So that's kind of you can be too long, too short, or just right. And one kind of rule of thumb is, if you're thinking, I need money for an initiative or a strategy that's going to roll out in 2 to 3 months, and if your loan is approved, you'll get the money just in time to put it to work for you without making payments on it in advance. That said, small business loans themselves can take 8 to 12 weeks to process and complete. And that's Ventures as a lender, and that's definitely true for us. It's a long and slow process. And so an important thing to think about is to really talk to your lender about what they think your opportunity is for approval, whether they think you're a good candidate for the kinds of loans that they have, and then work backwards from that assumption of yes. And so if you talk to a lender and you say, I need $5,000, and they say, okay, we think we can get that for you, plan backwards, kind of that 2 to 3 month window. So I'm going to pause there about these kind of big motivation questions on our checklist. Does anyone have any questions or anything they'd like to ask? I wanted to see if I can check the chat too. Okay, I don't even see the chat.
There's no questions in the chat right now.
Thanks, Bonnie.
Yeah, of course.
Okay, so we've kind of asked ourselves some kind of our motivating questions, and then the other thing I'm going to talk through is things you can reflect on about ask yourselves around your personal and business financial situation that can help give the view of what a lender would look at. So traditionally, in both bank lending and many kinds of mission-driven lending, the backbone of making an approval decision rests on what are called the 5 C's of credit. I think this is a little bit of an outdated framework. I don't think the 5 C's of credit necessarily show the full potential or picture of an entrepreneur. And entrepreneurs, sometimes I like to, it's cheesy, but there's no C's in entrepreneurs. But I do think it's important to have visibility into this framework and this process, and ask yourself questions around how a lender might look at you through this lens, and it can help you get a sense of what approval odds might be and who the right lender to work with might be. So the 5 C's of credit, and I'll share what they all are, and then we'll go over each one individually. And some of these are words that you'll know as part of being an entrepreneur, and they may have a little bit of a different meaning in the lending sphere, but they will kind of pop up or make sense to you. So they're capacity, cash flow, capital, collateral, and character. And different lenders may use slightly different words, but they're usually, I'll start with C, and they work in these 5 buckets that we're going to talk about. So the first one, your 5 C's of credit, is your capacity, which basically means, does my business have the ability to repay the loan? And one way to think about that, if you take all of your existing debts and then add to that the new debt from the loan that you're requesting now? Am I able to cover all the business, all the debts that you have? And an important thing to remember for many small business loans, especially for the smallest businesses and new businesses, your business income and debt will be considered alongside any outside personal income and personal debt. And that what will happen is a lender will make a global analysis of your ability to repay all of your debt. So in an example, or a question that came up earlier, what if I did have an outside job and I'm starting my business? So a lender might look at your payroll income from your outside job, your monthly rent payment, your monthly credit card payments, your existing student loan debt, then add on to this your new business debt request and say, can you make all of those payments using your personal income from your outside job? And if you can, that can help you kind of check the box in this capacity requirement. The second C that we like to talk about is cash flow. And this really means, can my business generate enough cash to repay the loan? And some things to ask yourself and that a lender might look at are around, one I talked a little bit about earlier, which is really important, is what's your historic cash flow? What did your business do in prior years? And I'll pause there and say, in this current environment, if you're thinking about business debt and you have an existing business, it's important to think back to 2019 as a really good marker. So you can be prepped to say to a lender, if you look at my 2020 cash flow or my 2020 financials, it may not look like I have the ability to repay my loan. But if we go back to 2019 before the pandemic, you may be able to show something different. Other things to think about is whether you've really considered all of the expenses it takes to operate your business and have thought through what that whole amount that needs to go out the door every month or every year to keep your business operating. And then once you've considered that, do you have enough cash in your business to make your loan payment every month? Another question that comes up a lot, especially for startup businesses, is, are our sales goals achievable? So if you start a business and your business plan and your business goals have you making $1 million in the first year, will a lender look at that and think that that's an achievable goal? And one way to really make the case that your goal is achievable is to do some analysis of other businesses like yours in the industry. Here I would give a plug to the library. They're a great resource to help you dig into sales trends and do some analysis of industries. And what you could say to help make your case to a lender is you kind of bring some market analysis. You say, I make shoelaces and the shoelace industry has grown by 300%. Here's some analysis of my nearest competitors. They all did $1 million in revenue in their first year. And so that's why I'm making the case that my sales goal is achievable. And so that's you're building kind of the building blocks to demonstrate that you've thought through your cash flow capacity or how much cash you'll have in your business every month to make the payment. So we had a question right off the bat, a really good question about fluctuating costs of goods and this landscape right now where it's not always clear due to supply chain issues and other pressures in the market, how much things are going to cost. And so when you're asking yourselves these questions about whether or not it's time to take on debt, I would take your regular costs of goods and use a multiplier. Depending on your industry type, the multiplier might be a little bit different, but maybe you take your existing cost of goods, you bump it up by 15 or 20%, like a pretty hefty hike, and then say, can I still make my loan payment even if my cost of goods skyrocket for a period of time? And the reason I recommend this pretty hefty hike is to think through like all of the things that may come into play. So We've seen how weather and climate change can disrupt supply chain lines. We've seen how the ongoing impact of the pandemic can disrupt supply chain lines. We've also seen how customers maybe are going to demand something different from you. And so if you built in kind of that factor right from the beginning, you'll be able to make a decision about a loan size or whether or not a loan is right, because you've built in that buffer. The next C that you can start thinking about is the C called capital. And one way to think about it is, have I, the business owner, contributed to my business with cash or other assets? And this is a tricky one, because a lot of times we're starting businesses because we don't have, we're starting businesses to grow our assets and to make cash. So one thing to think about is your sweat equity, how much time, and kind of personal investment of non-financial investment have you made in your business, and really make the case that you are committed to the business. By kind of maybe you've set other goals aside, or maybe you've reduced work hours at a wage job and you're really investing your personal skills into this business. Other things to think about are all of the ways you've probably invested personally in your business that maybe you didn't account for. So maybe the first time you got a business license, you put it on your personal credit card, or maybe you did some market research or some testing and you use personal funds for that. And if you can kind of collect together what that all looks like and come up with a number, that can help you make the case both to yourself and to a lender that you've made this personal investment in your business. If your business happens to own any assets, so if you've said, okay, my business was going pretty well and I used business resources to purchase a piece of equipment, so that's some capital that you can kind of point to as something that demonstrates your contribution to your business. Collateral is another C, and collateral, it's another one that it's like the chicken and the egg, and or the cart before the horse, or all of those things that you're thinking about. Well, I need my business to grow in order to have assets that I can use as collateral. And collateral is essentially the thing that you can use to secure the loan. And that gives the lender some breathing room to say, okay, I lent Erin some money. Erin wasn't able to pay me back, but I went and instead of taking money from her, I took her collateral to repay the loan. And the most common way we see this in our personal lives is with a car loan. You get a car loan and the lender says, actually, I own that car as long as you're making the payments on it. And if you miss payments, I'll just come and take that car back. And it kind of works in the same way in business lending. So things to think about are, do you have any cash in the bank right now? If you're sitting on a savings account, sometimes you can lock up your savings account in a secured account and say, okay, I'm going to make my loan payments every month, but on the off chance I don't, I have this savings account locked up that I'm not going to use for anything else. Sometimes you can secure a business loan with a car or other personal asset. This is something to think about, especially if you don't have necessarily other outside sources of income, but you can go to a lender and say, I'm starting my business in response to a pandemic-related job loss. I don't have another source of income, but I have a car, and I can secure my loan with that. If you have existing business equipment, that can be used to secure a loan. Or again, like we touched on earlier, if you're using the loan to invest in a piece of equipment for your business, sometimes that piece of equipment can also act as the collateral on the loan. The other thing I would say about this is when you're thinking about what kind of lender to work with, some lenders are more focused on collateral than others. So sometimes a bank will really need collateral, whereas organizations like ventures or other mission-driven lenders are not as focused on this as a way to to analyze a loan for approval. And the last one, and this is one that I think I maybe have the most trouble with, it's called, the word the lender uses called character. And what it's basically asking is, in the past, have I been able to pay my debts on time? And the way a lender does the analysis of this is they basically look at your credit report and your credit score. And again, they use this backwards looking lens to make a judgment on the future. So a lender will run your credit report and they will look at your credit history and say, based on what has happened in your life previously, we think you are, they'll make a determination on the risk of your ability to repay the loan in the future. I don't love that thinking, because I think it doesn't really take into account the reality of life, where things happen sometimes. And sure, for a time we weren't able to pay our debt, but we're making these changes and plan to make payments in the future. I also don't think that credit scores and credit reports are necessarily a great predictor of what entrepreneurs can do. But that said, there are some tips and tricks for thinking about how to get that ready, asking yourself how to get that ready to review with the lender. So first of all, taking a look at your credit report and your credit score. And if you're a ventures client and work with a ventures coach, we have coaches who really specialize in this. And you can work with a coach to take a soft pull of your credit. It doesn't impact it negatively, but you can take a look about what's on the report, review it for accuracy and correct problems. And then when you go to speak to a lender, be really upfront about your credit history. If you have a credit history that's been impacted by COVID, the pandemic, or any of the challenges of the last 19 months, if you are able to unearth a credit report from before that time, and now you can go to a lender and say, look, here's what my credit looks like in kind of normal times, and here's how it was impacted by the pandemic, and ask them to really consider you in light of some of those issues. Earlier on, we talked about what is the right time, asking ourselves what is the right time to apply for a loan. And if your right time is 12 months from now, that can be enough time to make some positive impacts on your credit score and credit history, and really be diligent about making your payments on time and keeping collections off of your credit report. And then sometimes, especially mission-driven lenders or non-bank lenders, will look more favorably at what happened recently on your credit report, and you can say you've been working on this for 12 months and made some positive change. And finally, if you're asking yourself about this kind of character or credit score kind of history, are there ways to think creatively about how you can approach a bank with this? Some people use a cosigner. Some people really, again, use some of the other C's that we've talked about as shoring this up. You might say, okay, well, my credit score is a little bit lower than I would like, but I'm going to offer collateral at a time that may not have been asked for originally. And then therefore, you might be able to get around some of the challenges on your credit report. And with all of these questions, so we've asked ourselves, what's my motivation for needing to borrow? When's the right time for borrowing? What are kind of, how am I going to look to a lender using that lens of the 5 C's? And now we can talk a little bit about who should I work with on my business loan. One thing to think about to start, you can ask yourself, is a traditional commercial bank the right partner for you? And using some of the analysis you've already done, you can ask yourself, do I have collateral available and a high credit score? So sometimes a commercial bank will say, okay, here's this person who owns a home. They have a high credit score, and we will maybe take take a second position or a lien on their house and use that as collateral for their business loan to get them started. If you're thinking about working with a traditional bank, you might want to ask yourself, is your loan something a bank has seen before? Or is your situation unusual or new? And banks are great institutions. They do a lot in the world, but they also are kind of follow a traditional path generally to say these are the kinds of businesses we lend to in the past, and so this might be who we will lend to in the future. And if you're doing something really new and really outside of the box, a traditional bank might not be your best partner. And then ask yourself, so I think we've all maybe worked with a bank or heard of somebody who's worked with a bank on any sort of numbered processes. So I know that if I go to deposit a check at the local bank branch, I might see somebody at the drive-up window. If I call the bank, I might talk to somebody else on the phone. In a lot of cases, I might not ever talk to somebody. I get a robocall or a chat bot on when I log into my bank account. And so if it feels right to you and feels comfortable, then a bank is a good partner. If you need more or would like more one-on-one or specialized support, banks don't always offer that. So who else can I talk to? Well, is a CDFI or mission-driven lender right for me? So I've used this word CDFI a couple of different times, and it stands for Community Development Financial Institution. Ventures is a CDFI. There's 4 or 5 others in the kind of Puget Sound area, 5 or 6 others in the Puget Sound area. And CDFIs have a responsibility to help grow businesses often, but they do other things, and their responsibilities to kind of step in and help the economy grow where a bank can't. So a CDFI tends to have more flexibility than a bank, and that's their responsibility to make loans that a bank would not make. So things to ask yourself before thinking about whether a CDFI is the right way to go is maybe asking, does your business or financial situation have a story to tell or require some personal explanation? So if you're thinking maybe you had some bumps in the road with your credit score, credit report, and you can explain why that is. It's a lot easier to make an explanation to someone at a CDFI than it is at a bank. Can ask yourself, you've got this great idea for your business and you need a loan, and then ask yourself, do you want to work with someone to help that? And again, CDFIs tend to be set up that they have coaches or advocates to work with you during the loan process and during your business planning process in order to not just get you the loan, but help your business grow. So the last kind of thing I want to kind of point out and talk about, and this is especially powerful and relevant these days, there are a lot of online loan options or merchant cash. Sometimes they're called merchant cash advances. I don't want to throw any organization under the bus or disparage anybody, but sometimes what you will see is an offer from Square Capital, say, and that just springs to mind because I know what they are, and they may say, oh, do you want some cash in your business now, and we will take payments from you every single day to pay us back, and that's called a merchant cash advance. It's essentially an advance on potential future sales in your business. There's others online loan lenders that make business loans, but have pretty high interest rates. And when you're working outside of the space of banks or CDFIs, and you're working, sometimes they're called fintech, sometimes they're called online lenders. It's important to just kind of pause and make sure you're asking yourself powerful questions about those opportunities too. I don't want to say they're 100% all of the time bad, or that entrepreneurs who take out a loan like this it's automatically terrible, but again, it's a time to ask yourself some questions and make sure it's the right fit. Important things to know if you take out a merchant cash advance or online loan is understand, does it have a posted fee or interest rate? And do you understand how the fee or interest rate affects repayment? A lot of times, some of these loans don't necessarily post their fees or don't post their fees in a way that make a lot of sense, or at least not a lot of sense to me. So you might discover that you're paying 60 or 70% or more in interest on a loan, but it wasn't posted in a way that really rings true like that. So you have to do some digging. And then ask yourself, is this a loan in the traditional sense, or is it an advance on my future sales? So sometimes merchant cash advances will put cash in your bank account now based on sales that you've made in the past, assuming that you're going to continue that rate, and then basically take that money back from you as you continue to make those sales. And then ask yourself, will the payments be drawn directly from your business weekly or even daily? And then how does that impact your cash flow? So if you took out a loan and then instead of making a monthly loan payment that was predictable and stable and the same amount, is this online lender, fintech lender, merchant cash advance service going to take that money out of your bank account every single day? And when they do that, it can be really hard to plan. I'm going to stop sharing, come back here, and really open up for questions. And then what I also want to do is share a couple of examples of places that we've talked about that might be resources to go to address, to either check in about borrowing or to get more information. So first of all, if you're a ventures client, you have ventures. We have a capital team and a loan program here, and we're always excited to talk about our loan program and our lending, and what we think about when we think about both the questions that we encourage you to ask yourself, and then what we consider our 5 C's of credit. If you have questions, feel free to unmute and interrupt or ask in the chat as I start putting things in here. Other local CDFIs, I'm going to add some of their information in the chat. One is called Business Impact Northwest. Another organization that's local that is again a CDFI and a mission-driven lender. So those are folks who, unlike a bank, can kind of consider alternative ways thinking about business debt. They're both in the chat, and both of these organizations will be joining Ventures this Friday at 1 as part of our kind of a community partner meet and greet, and you can meet representatives of them there. They, like Ventures, have a mission-driven component or a mission component of their lending, and so they're more flexible. Tend to be more willing to work with startups. So they're both there. There's also another one. I've got all these links everywhere. Make sure there is what's called Rainier Valley Community Development Fund. So if your business happens to be located in Rainier Valley, there's a great kind of mission-driven lender based there. Okay, so those are some of the CDFIs, or the non-traditional lenders in our area. They each have different ways that they're going to analyze your business, but things to kind of keep in mind as you will likely be working with a person who is going to want to ask a lot of questions and unearth your business plan and walk you through that process using both kind of the traditional things we've talked about on this call, and then driving down into your business planning and your process going forward. And then the last thing. Okay, are there questions? I'm just talking away. Does anyone want to unmute and ask anything? Okay. I have also, with the few minutes left, been asked to talk in this presentation about something called the Washington Flex Fund, which is another loan opportunity. It specifically exists to get capital in the hands of entrepreneurs, particularly those who have been impacted by COVID-19. They are looking at existing businesses, but I'm going to share some information about it in the chat, and then I'm also going to share my screen so you can kind of see what you would be looking at if this kind of loan is right for you. So the idea here, the backstory here is that the state of Washington is backing small business loans. So the state of Washington gathered together a group of lenders, and they said, we want you to go out there and lend money that's at low interest to small businesses and nonprofits who've had impact from COVID-19. And the lenders said, okay, we'd like to do that, but those are kind of risky loans. We've all just been through this pandemic. What are we going to do? And the state said, well, we'll guarantee those loans. And that means that the lenders have a little bit more flexibility because the loan funds are basically guaranteed by the state. So what are offered are small business loans with fairly low interest rates. They range from about 3.5% to I think 4.25%. And they're 60 to 72 month terms. And small businesses can apply for up to $150,000 for all of these expenses connected to kind of keeping your business situation structured and afloat as we move beyond COVID-19. The idea here is about flexibility and re-emergence. So there is some ability we've talked about earlier when we were deciding like what is the reason to try a new loan or to take out a loan, and one of the reasons might be to try something, to pivot or try something new, as long as it's not overreaching or just chasing the latest fad. But if you've said in your business, you know, what I've really seen over this last year is that my to-go sales are going to stay high. Even post-pandemic, I know that people are always going to now want to come in and take some food to go. That might be a new thing. So you can use these kinds of funds to invest in those kinds of business pivots. Oh, here we go. So small business terms are actually 4 to 4.5%. If you have a nonprofit, they're a little lower. Important things to know is you do for this loan need to show experience direct economic hardship due to COVID-19 and had to have been in business for 1 full year prior to June 30th of 2021. So you had to have started your business either before the pandemic started or right at the beginning. So for those of us who are maybe saying, I had to start my business in response to a pandemic job loss, this is an opportunity to explore, particularly if you started your business early on. And what I'm going to also show is the steps to apply. And I'm not going to go through it all, but we have been asked to really just show you that what happens is a pre-application process where, again, I'm not going to enter all of this, but you enter some basic data into their system, and they ask you some questions. You move all the way through these steps in their process, and at the end of that, if your questions, if the way you've answered their questions aligns with a lender that they're working with, you will be matched with a lender, and then you will go into the full loan application process where it's formally looked at and a loan approval decision is made. So I'm going to stop there. I think we are at the end of our time. I want to emphasize that if you're a ventures client, you have access to coaching and insights and business plan support for your loan application. If you are not currently a ventures client, I really encourage you to come and meet with some of these other CDFI and lending partners on Friday at 1 p.m. and they'll be able to talk you through a little bit more about their individual process. And for anyone who's thinking about a ventures loan, taking that time, or any kind of small business loan, taking that time to reflect and dive deeper into kind of those non-traditional questions can help you decide whether a loan is right for you, whether this time is right for you, and then how a lender might be looking at your financial situation. And I hope you all are staying for our amazing presentation next. Bonnie just shared what it is in chat.
That when we are looking at a hybrid workplace, we're talking about the ability that the employee has to do work in a central location that everyone has access to,